introductions.
All righty, I think we're live. GM, we're here for the Compound Q4 analyst call. If you're not familiar, we've done one. This is our second iteration, actually. We did one back in Q3 with Watkins and some other people. This is our second iteration. And my name's Dustin. We have Sami here as well. We're both from Messari, and we kind of co-authored the report together. And we have Getty Hill here from GFX Labs, really prominent member inside of the Compound community. But, just quick, what we're going to be covering today, it's very similar to kind of if you've ever been familiar with like equities calls and kind of Q4 results. That's what we're looking into is the health of Compound, kind of the metrics that matter, and really trying to peel back just, what went over Q4. But before we do all that, Getty, why don't you kind of walk us through like, your background, GFX Labs, and kind of the role that you guys play within Compound.
Yeah, sure thing. Hi, everyone, and thanks for having me here. Huge fan of Compound and been dabbling in the protocol for a long time. My background comes from 3 years of trading and running delta neutral strategies at Grapefruit Trading. And then myself and my buddy on the trading desk decided to leave and start GFX Labs. And we've been involved in Compound for a very long time. Loved it when the protocol launched comp tokens and kind of gave this opportunity for individuals to come in the protocol and interact and improve the protocol and do fun things. So we've done things like update the price oracle, add new assets to the protocol, all sorts of fun things, and just real big fans of money markets and Compound in general.
Awesome, man. All right, hey, well, let's just jump into it. Sami, you want to kind of give us the 30,000 foot level and give us kind of the macro results?
Yeah, sure thing. Let me just go ahead and share my screen here. Is everything all good? Can you see it on your end?
Yeah.
All right. All right. So we're going to go ahead and get things kicked off, start with a little macro overview. So we know that Compound is a financial service business, and this matters because they're influenced to an extent by the broader crypto market and the macro environment. So there was a lot of action that went on in Q4. We saw 2 breakouts in Bitcoin leading to new all-time highs. And we also saw a breakout in just total crypto market cap with a new all-time high there as well. So due to this, we saw Q4 ending with quarter-ending highs in several key categories. And so we'll kind of step through this macro chart that's on the screen, walk through the key performance indicators as well as the financials. But one thing I want to preface with is just looking at this Q3 data. So at the end of Q3, there was a comp distribution bug that was introduced into the protocol. We'll go into this deeper later on. But why this matters is that, so this bug was introduced on the last day of Q3, so September 30th. And the bug caused some panic, caused some fear, there's some uncertainty. And so about $3 billion of closed loans and withdrawn deposits affected the Compound market. And so the Q3 metrics they came in basically a lot lower than what they would have been, for example, if that bug, it was introduced like the next day. And so I just want everybody to keep that in mind when we're walking through this, because when we look at the percent growth to Q4, it can seem high for what it really is. But if that's a little bit confusing, it's a lot easier to visualize once we go on to the next slides, where you can see the liquidity and the capital moving throughout the Compound markets. So starting out with the outstanding loans for Q4, we were at about $6 billion. That's about 7.5% growth compared to Q3. Outstanding deposits were at 14.3 billion, pretty much stayed flat compared to Q3. Very low growth there, 1%. Quarterly originations, also known as borrowing volume, came in at 11.4 billion. This was down compared to the last quarter. And then deposit volume was up quite significantly to 63 billion. Liquidations were at 34 million. This was a slight increase from the last quarter. And then we had aggregate utilization. That's sitting at 41.7%. Pretty much for the past year, we've just been ranging between the high 30s and low 40s. Moving on to financials. So total interest income for the protocol was $90 million. When we look at the interest, when we take out the interest paid to depositors, which was 80 million, you're left with a net interest income of 10 million. And that's a pretty decent growth from last quarter. You're looking at 11.1%. There were no grants paid out this quarter. The grant program ended, I believe, in September of last year, but the compound team, the compound grants team, is currently working on the second iteration, which should be out in 2022. Currently no date set yet, but that led to the net income of 10 million, still close to a 20% growth. We're running a net margin of 11% on the protocol. And when you take out the token incentives paid, which was about 55 million, the adjusted net income for Q4 was a negative 45 million. And that was a significant improvement from Q3, about 41% growth. Now, before we move on, Getty, just a question for you. What do you find to be like one of the most important metrics or KPIs that you like to keep your eye on?
Yeah, great question. I think as these protocols have transitioned, especially Compound, out of its total infancy and have been around now for a bit over a year, really one of the more interesting things to begin to think about is that net interest income line there. And the growth and the really steady progression of the protocol over the last 4 quarters, coming out to about almost like a little over $40 million in the year is really impressive, considering the amount of resources that are being deployed to earn that income. It really demonstrates that these protocols are being able to run themselves and generate some nice income in doing so.
Great, yeah, I agree. Dustin, you want to take this one?
Yeah, man. So what we're looking at here, this is our outstanding loans for Compound, and it really going to illustrate a lot of what Sami was talking about, particularly around the comp distribution bug. So if you look at what is the right quarter of that screen, you can see that the almost rectangular trough. That's that period of the comp distribution bug. And then from that point on, we quickly resumed loan levels. Pretty much, obviously a little bit under than where we were in kind of the ending of Q3, but stayed pretty flat until December. So what's happening there also, you got to remember, Compound's very, it's driven by the kind of the borrow or the demand for leverage. So during that time we had Bitcoin hit essentially 2 new all-time highs at the end of October and then ended November as well. So that's kind of fueling a lot of that growth there, or at least during that period. We've mentioned this comp distribution bug a couple times. Getty, do you want to just real quick, what is it? What does it mean when we say that? And kind of just walk us through a little bit of that timeline in that early October period.
Sure thing. So for everyone who might not be super familiar with Compound, Compound, when it was started, came and invented the comp token and a part of incentivizing participants to deposit liquidity in the protocol and distribute the comp tokens in a decentralized fashion. The labs team decided it'd be an interesting idea to distribute the comp tokens for market participation. For example, if you were to deposit some USDC in the Compound, you would earn your pro rata share of the amount of USDC deposited in some comp tokens that were being distributed to that pool. For the longest time since the inception of the protocol and that feature, it was distributed in a 50-50 split where the same amount of comp, let's just say there was 20 comp per block. I'm just making up a number right here, 20 comp per block. Obviously, it's not that number. It's getting distributed half to all the suppliers, half to all the borrowers. And the thought was, hey, it would be really neat if we could adjust those parameters individually. So if we wanted to give 15 to the suppliers and 5 to the borrowers, we should be able to do that. So Proposal 62 originally, the premise was to introduce this new piece of code that would allow the parameters to be adjusted individually. Unfortunately, there was a small error in the code that was literally resulting in a greater than or equal to sign that was missing. The greater than sign was missing in the code, and it ultimately introduced a bug into the code in calculating some of the supported assets and in how they're essentially were indexing these rewards and how the math was being done. What happened essentially was there's a bunch of people who had assets in the protocol that were earning yields all of a sudden earned substantially more than they should have otherwise been able to. And were able to claim significant amounts of comp. In some cases, it was more comp that was even in the existence of the protocol. So those were automatically failing transactions. In other cases, users were able to claim 10,000 or 50,000 comp from the protocol's incentive pool. This luckily didn't hurt any of the users' participation in the protocol. Really what it was here is it was an unfortunate event for the protocol itself and all the comp holders as it entered a significant amount of comp into circulation that wouldn't have otherwise all been immediately entered into circulation. But everyone's loans and positions in the protocol were entirely safe. No one had to be concerned about their coins at risk or being stolen or any of that. It was really just an unfortunate event for the protocol, distributing a lot of money to a bunch of individuals in an unfortunate fashion. Luckily, there was a lot of great effort amongst community to figure out exactly what had occurred that went wrong and react to it best we can. Now, this is where it gets interesting in the way of how governance functions. And feel free to cut me off here because I could probably talk about this forever. But what ended up occurring here, because Compound is in fact entirely run by governance. The only way to change a code change after change any code ever is to introduce a governance proposal, and the governance proposal timeline is about 7 days. So once the change was even introduced in the protocol's hands are tied. Governance can't actually rush to its aid. There is no multi-sig. There is no, Robert Leshner doesn't have a special key somewhere where he can run in there and, fix everything up. It is truly decentralized here in a painful fashion in this instance where the protocol is bleeding funds. So long story short, we managed to get some fix in place, and in less than, once that governance cycle had gone through, everything was back to normal, and then became, how do we prevent this bug in the future, which I think we'll get into more later in this call. But that should be a quick synopsis on what kind of occurred there on the back of those of that event.
No, that was great. Yeah, no, very, very good detail. So then, once that was resolved, that was it took, I think, mid-October by the time the proposal resolved, it got enacted. From then on, it was almost more or less business as usual. But a couple of key things that we can look at this chart and peel apart that I thought was interesting is really, one is pretty clear that the light blue and the dark blue, those are both stable coins, right? So stablecoin borrowing obviously dominates because people want their debts denominated in stable assets. So the mix between these two is actually kind of interesting. So this is the first quarter that we've seen really DAI almost outpace USDC. So DAI kind of came in initially to the quarter as not the most borrowed asset. That was USDC. And then over time, it's a little bit harder to see in the chart. You see USDC with a slight decline is while DAI is basically increasing. I think DAI increased outstanding loans roughly 34%, while USDC was kind of slowly down 7%. So I think that's going to be an interesting narrative that we kind of talk about. I don't know what your opinions are, Getty, but just kind of the growing importance DAI is kind of growing in the protocol relative to USDC.
Yeah, what's interesting is, throughout DeFi summer, there was it was seemingly evident that a lot of funds in crypto were very fluid and that money was moving at a rapid pace. And what we've kind of seen now on the back after a year plus time is that there's actually a substantial amount of funds that are actually quite sticky and that have a preference to certain protocols and certain assets when it comes to what they want to borrow with, what they want to leverage themselves on, and where they want to leverage themselves. And so I think a lot of the data throughout this report and a lot of data in general supports that there is a significant amount of funds that are interested in simply supplying ETH in a protocol they're very familiar with and borrowing a coin that they're very familiar with in the ecosystem DAI. And similarly, there's a lot of DAI interest on the other side of this, supporting rates, stabilizing and keeping them low to make it more attractive in many cases than USDC borrowing, thanks to the quite colossal size that DAI is in the Ethereum ecosystem.
Yeah, no, I agree. I think it is interesting that we're like starting to see that kind of almost be more adopted as well, like as time goes on. And you can even see it like in like you brought up the interest rates, which is a good point. Same if you jump down a second, where like so the interest rates typically follow almost basically the market correlation. So as Bitcoin's breaking out there in November, you see in the right half of the chart, the interest rates are going to spike for the protocol. But you know, back to it, like USDC and DAI are the two most borrowed stable coins. USDC is really driving that average borrowing interest rate spike. If you look at the DAI chart, right, it's almost basically flat to your point. And that's really driving a lot more, I guess, demand on the demand side, on the borrow side.
Yeah, I think it provides a lot of certainty, right, for people, right, when all the DAI that's in existence is all essentially these dynamic but fixed term, like fixed rate loans, right? As MakerDAO governance picks a rate for individuals to borrow DAI at, and it provides this kind of a steady hand of like, hey, like this is what the cost of DAI is at its source, and it kind of sets the pace for everyone else. Where the dollar rates, dollars are king ultimately, and are fluctuate wildly, and typically are driven by the cost of capital at some of the big lenders, and in particularly in the leverage markets, when we look at like perp markets and whatnot. Mm-hmm. That's perhaps where the big dollar driver is in crypto.
Yeah, no, it's a great point. I mean, like it's I'm glad it's like almost becoming more prevalent too, like more recognized, and because like that's what we really saw in the quarter is DAI like even be more adopted within Compound, and like being a decentralized stablecoin kind of gets more to the ethos of DeFi in general. So I mean, another side of this also is the supply, right? And Sami, you're going to get into this a little bit. Is the supply of DAI, right? I think in December, right, Coinbase announced their DAI DeFi yield program, which, you know, if you look at like the day they announced, which was I think December 8th or 9th, at that point on, like 75% of all the DAI that was deposited during the quarter was in that time period. So you're getting a lot more, you know, DAI influx to the protocol during this period, and then in the future we're going to see probably a little bit more. Getty, I know you've done some work on the maker side to kind of get the direct DAI injection. So there's just a lot happening also on the supply side as well.
Yeah, absolutely. It's the DAI direct deposit module that we've been working on with MakerDAO is currently functional on Aave. And essentially the idea is the protocol has a lot of capital, and they're sufficiently over collateralized. Why not print some new DAI, put it into circulation? The protocol gets to earn a nice yield, and then they also can keep a steady hand on interest rates throughout the world. So they want to make it such that DAI really becomes a prevalent asset. And while Circle might not necessarily be out there injecting hundreds of millions of dollars into protocols directly, certainly share their influence through some of the big trading desks and lending partners that they have. But MakerDAO really going out of their way to set up direct collaborations with protocols is a really neat way of DeFi, supporting DeFi and providing liquidity in a win-win scenario where Compound gets a lot of liquidity in these protocols that they are going to plug into. In the case, it can be hundreds of millions of dollars worth of DAI at a non-existent cost to the protocol. MakerDAO gets to put more of their currency in circulation and keep rates low to make them the preferred borrow asset for individuals who are seeking leverage. And it's just a win-win for everyone. So we're really excited about bringing that direct deposit module to Compound. That's something we've been working hard on, and I think will provide a significant amount of value.
Yeah, no, I totally agree. I think that's huge. All right, hey, Sami, why don't you jump in and kind of almost, since we've kind of been talking about deposits here for a second, give us an overview of the quarterly deposits.
Yeah, so outstanding deposits, largely a similar story to what we saw in outstanding loans. You kind of see that you see the effect of the compound distribution bug in October. Like Dustin was saying, you're really starting to notice DAI take over as one of the it is actually the most borrowed asset. And it's also becoming a more popular asset to deposit. And one of the main reasons that Dustin already touched on was due to this Coinbase DeFi yield product integration. And so they allow their users to basically submit their DAI and then gain yield on it. I think this really goes back to what Getty was saying about kind of getting that sticky liquidity into the protocol and just really kind of helping out both the Compound protocol, but then as well as helping out Coinbase and their users. So, I mean, because of this integration, you saw DAI flip. Well, so let's start with Wrapped Ethereum. So Wrapped Ethereum has always stayed the largest deposited asset on Compound. And historically, the second most popular deposited asset was USDC. What we saw in Q4 was really DAI kind of take over as that second most important or most popular deposited asset. One thing to notice is that we really do see that Wrapped Ethereum makes up such a large percentage of the overall outstanding deposits. But really in the previous quarters, you kind of see that begin to kind of just flatten a little bit. And there's probably a lot of reasons for this. I mean, one of them could be the whole Ethereum 2.0 staking option. But really, I don't know if you have any thoughts on this, Getty. But another thing to note is the growth in outstanding deposits from Q3 to Q4 was relatively low. It was about 1%, but this chart is in US dollars. And so if you were to remove the asset price increase from Bitcoin and Ethereum from Q3 to Q4, you'd actually get a negative growth rate for outstanding deposits. And so you're starting to see deposits sort of slow down into the Compound ecosystem. But again, it could just be because of the general macro. Markets got a little bit heated towards the end of the last year. And then you could see there's a little bit of a sell-off that happened in the end of December. And you kind of see deposits start to taper off as well.
Yeah, there's been, I think the Q4 period, and especially after the Compound era, one of the claim to fame for Compound was that it's the safest protocol, it's the safest money market that exists, longest running, never had an error. And while 62 wasn't an error to users, either way, it's something that scares people. The fact that such a thing could have occurred, it's frightening without a doubt. While it didn't hurt anyone, it's hard to change that perspective. So I think that certainly didn't do the protocol any favors, and that's why we've done stuff like Contract now opens up when they come on and be the full-time auditor for the protocol and audit every single governance change that's made from here out, in addition to looking towards some of the larger participants and voters in the protocol, taking their position as large governance token holders a bit more seriously as well on the back of that. I think those two things, will make a big difference in light of the error that kind of occurred there on that comp distribution bug. As far as other things go, I mean, it's definitely a competitive environment these days when it comes to money markets. Aave definitely has done some clever things to really put themselves as the dominant participant along with MakerDAO. And so in addition to Compound competing then with MakerDAO and Aave, at the end of the day, Compound's bread and butter is margin leverage, right? Users are posting up coins like ETH and going along with cash stables. And we've seen the likes of FTX and Binance really surge up in their leverage product offerings, particularly their perpetual products throughout the world. And at the end of the day, we're all kind of competing for the same market share of those users who are interested in getting levered long on their assets. And with the domination that's kind of occurring at FTX and others, those are all competing products that we kind of have to take into account as we continue to build out Compound.
Yeah, I think that's a really good point that you added. yeah, the market's competitive, and it's really got to rely on adding new features and just continuing to build that trust. And I think you touched on the Open Zeppelin partnership, which is a really important tool, especially because Compound is, I would say, like, correct me if I'm wrong, but one of the only protocols, or one of the first protocols specifically, to go down the route of decentralized governance, but also like decentralized development as well. So they're pretty much paving the way and setting an example for other protocols when it comes. And of course, it's the first mover is going to encounter a few difficulties here and there, but really it's all about the community kind of learning from that and adapting and just continuing to make improvements.
Yeah, exactly. That hits the nail right there on the head. We're the ones who are going to experience a lot of the growing pains, being the father of DAO governance and the Governor Bravo contract and Alpha contract now being so widely used in the space. I think MakerDAO is a great example of a protocol that had a lot of its own challenges, being the first and kind of foremost DAO that exists in the space. We're similarly going through a lot of those growing pains when it comes to how do you incentivize participation, improvements in the protocol, security and risk management in the protocol. So the likes of an Open Zeppelin getting contracted and getting paid millions of dollars to come in here and do great work and have full-time individuals dedicated to the protocol, I think is going to be immensely helpful for participants and for the protocol's progression in general. And then, also the likes of, Gauntlet innovating on risk parameters and trying to do risk management. These are all super new, interesting things that are certainly not perfect today, but everyone's doing their best to figure it out. And ultimately, that's the beauty of DeFi, is solving these weird problems that you won't really find elsewhere. And luckily, there's a lot of incentives in many cases to drive that. And in other cases, everyone's willing to have the hard conversations to drive that progress.
Yeah, and I think we can touch on the kind of that incentivization process as well later on. But moving on to depositor interest rates here. So Q3 saw all-time lows as far as depositor interest rates go. And the Q4 interest rates were relatively in line with that as well. So if you take an average of the annualized deposit rate for Q3, it was around 1.8%, and that average for Q4 was about 2%. So a slight increase there. But I think these rate stabilizations really indicate kind of product maturity at Compound, and just that consistent, there's a consistent demand for deposits, and that demand is constantly met with that borrow demand as well. And I believe that's really best highlighted with this utilization chart. So one thing to notice is that this utilization ratio has been trending down since around the end of 2020. And so that just kind of highlights that you have depositor growth continuing to outpace loan growth, which is bringing down borrow rates for borrowers. And especially with the rapidly maturing stablecoin market, I mean, we've seen the stablecoin market go exponential, like in 2021, right? It's just skyrocketed, and so the utilization rate, of course, is going to decrease, especially as supply just starts to meet demand.
Awesome. All right, so this is what we're looking at here. This is protocol income, and Getty, going back to, you picked my favorite metric as well on the macro chart. So to me, this is the culmination of really what we're going after. You can have a bunch of liquidity in the protocol, you can have a bunch of borrowers, but it depends on kind of the take rate or the reserve factor that we're charging here. And this is specifically the interest income. So that's really kind of the name of the game for Compound. Is what matters at the end of the day, in my opinion. So I want to spend a decent amount of time on this chart, really kind of picking apart, not just what happened and the results, but also kind of looking forward and how do we really think about just the revenue mix in general, and kind of directing certain levers that we have to pull in a strategic manner in order to really optimize for revenue growth. But first, just to give it a quick narrative of what we're looking at here, right? We see from Q3 to Q4, from there, that's about 10% growth. But if you factor in grants cost, it's roughly 20% growth in net interest earnings. And again, going back to my little DAI versus USDC talk, we're again seeing DAI, increase relative to USDC in terms of like protocol importance. And so it's driving, in this image, roughly 50% of all the compounds income, right, in Q4. And that is due to a couple of reasons, right? Like its reserve factor, I believe, is higher than USDC. So on a per loan basis, it's more income for the protocol, right? So Getty, let's talk just a touch about like, what do you think about are you looking at like this kind of data, and like what levers do you think we should be pulling in order to incentivize different revenue mixes and stuff like that? Like how do you, I guess, approach the revenue mix for Compound, and how do you think about it?
Yeah, so you think there's two big components to revenue today. That is one, the primary driving factor, and especially the one in the long run that drives income for the protocol. And that's assets borrowed from the protocol, and the protocol takes its cut of that reserve factor up there in the form of these assets. And so at the end of the day, we need people to not only supply assets to the protocol, but most importantly, borrow assets. And that's why we see here on this protocol income slide, USDC and DAI are the dominated things. People at the end of the day are most interested in levering long in their assets. The market, I think, thankfully for my positions, are very interested in borrowing tons of ETH and going the other direction. And so what we see here is a lot of the protocol revenues end up being dominated in stable coins. So what that means as far as growth and how do we increase these numbers over time, I mean, supporting more assets that individuals are interested in using as collateral to borrow then more dollars and seek that margin long. So whether it be talking about supporting ETH2 assets like Lido's staked ETH product or other similar staked ETH products, or supporting LP tokens as we really look towards the future, those are the things that will kind of be the most pressing developments to drive protocol income up and just general TVLs up in a very natural fashion. Now, the other half of that coin, which is the not so pretty part, is the comp incentives that we distribute through the protocol right now. The portion of here, while we're looking, okay, we get made $10 million in Q4. I don't know the exact number off the top of my head, but if I had to like ballpark it from the research I've done, we probably spent 50 or 70 or 80 million dollars in comp incentives over that period at the same time. And so a lot of that income that we're earning is in many cases the symptom of a lot of those incentives. As we're incentivizing people to deposit assets in the protocol, we're also similarly incentivizing them to borrow assets for the protocol, and we're earning a small percentage of the money that we're paying them to borrow also in the form back of those stable coins. So it's the other side of the coin is not so pretty, but then again, I think that's one as we might talk a bit more later in the call about as to how do we use these incentives in an efficient fashion, really reduce the protocol's annualized spend right now of comp incentives, which is a bit north of $100 million a year.
Yeah, no, I mean, it's definitely a discussion I want to have, because I find it pretty interesting as well. Like, because like it obviously makes sense when you're a newer protocol and you're like starting up liquidity and stuff like that. But like particularly like, let's just like it almost loses effect, right? Because it's a big statement, but like if the borrowing assets are in stable coins, and then we're putting all this essentially sell pressure on the comp token, and you're keeping the comp flat, or like the comp emissions flat roughly, then you're losing like a per dollar impact that you are for supply. Like, so like the reward rate that I get, let's say it was 4% flat, no incentives for depositing or something, as time goes on, we're seeing that juice get to be like, okay, it's 4.5, right? As opposed to previously when the comp token's higher, it's a higher margin there. And you could see it on Sami, we got a slide on the comp emissions there.
Oh, comp emissions, yeah.
Yeah, I believe it's that. So like across this period, like Q3 to Q4, like we that's what 30%-ish in US dollar terms that we're emitting comp tokens, but it's only 5% less or so in actual comp tokens. So it means like we're getting less bang for a buck more or less. You know what I'm saying? So
Yeah.
like yeah,
exactly. The protocol is distributing, largely a fixed amount of comp. The amount of comp that we're distributing is really not changed significantly over the period. Occasionally has, as we've introduced assets or taken assets out of that mix, but really it's remained the same. But at the end of the day, a lot of the protocol's participants, whether they be individuals or trading firms or funds, whatever it may be, a lot of them are all denominated in dollars, right? They report back their P&L in terms of dollars. And so they look to see, okay, well, while the comp tokens are remaining a fixed number of tokens, ultimately what we care about is, what's my bang for my buck? So if comp's trading at 800, the protocol is distributing dollar notionally significantly more value than if it's trading at, $100. And so what's interesting is we've done a lot of research on this, and similarly, if you guys were to compare here the amount of participation in the protocol with this comp token incentives paid, we're seeing a huge decrease from over Q2 to Q4. There 101 million to 55 million, but you're not seeing the protocol's participation similarly half in value, and that's I think a great representation that, hey, while there is a lot of participation here that's interested in these comp incentives, there's way more that is actually naturally here. And that is the stuff that we want to, hang on to.
I think that's a good point. Even like, I just think even to think about it even more strategically, right? Take it one step further, it's like, all right, we're kind of paying out comp rewards across the board on different assets as well. But like, as we look at, right, going back to our revenue, right? It was DAI making up 50%. We've got kind of some partnerships or integrations, at least driving a lot of DAI supply. So like, does it make sense to incentivize DAI supply longer, or do we direct comp emissions towards like assets that do drive more revenue in order to kind of, to really kind of focus in on what matters to the protocol, right?
Yeah, absolutely. I think, the comp incentives came about from an original idea of the Comp Labs team kept a good portion of the tokens for themselves and their investors. And they said, okay, well, let's give the rest of them away to the users of the protocol. And so the original idea was, what better way to give them away than the participants in the protocol? And this is, mind everyone who's listening, who's now familiar with the crazy world of airdrops that exist. This is really before airdrops had really become a thing. Uniswap was, airdrop was, I don't know, something like 6 or 7 months after that this occurred in the fall, whereas this was back in like May. That idea didn't really exist. So it was like seemed sensible to distribute tokens to participants. And so that was really the impetus of this. And that's where it gets a bit more philosophical about, do we want to end incentives or do we not? It hurts current holders, but also the original mandate from the team was, hey, these were meant to be distributed to a lot of the users. And so we've seen a lot of interesting debate develop around what's the best way to allocate comp token most effectively so that it is distributed and decentralized, but also such that we don't do needless spending, as in my opinion is kind of what's occurring today.
Yeah. I think that's a good point too, because I mean, there's different strategies you could take to, rather than just tapering all comp rewards to zero, you could potentially use that to maybe kickstart new markets, right? So like incentivize people to provide liquidity for that specific market. And so like, what are your thoughts? Like, where do you see this kind of going? Do you see it more strategically being planned? And if that's the case, does it kind of just have to be, you guys have to create some type of parameters that have to be set? Because it seems like a really difficult topic to kind of discuss, and because it's very subjective, right?
Yes, it's all quite subjective. When I originally went down a rabbit hole of being like, hey, is there a way now in the back of 62, once we got all the dust settled and we have these new tools, hey, is there a way to like materially improve the amount of money that we spend on the protocol and more efficiently, spend that cash on the protocol to increase participation and get incentives targeted fashion? And it really boiled down to being a very subjective process. So I think at the end of the day, the most realistic point for what comp rewards are supposed to be doing is for incentivizing liquidity in markets that do not have liquidity. At the end of the day, the protocol's mission is to provide a venue for individuals to come and borrow tokens. And if we don't have tokens for those individuals to borrow, then we're kind of failing our mission there. And that can be quite difficult as we onboard some new markets, as the protocol has been doing over the last several months. And turning on comp incentives for those, starting up some type of like regular program where it's say, hey, month one, you get this number of rewards, month two, you get this number of rewards, and it staggers off over a 3-month scale back down to 0. And we have a fair amount of evidence now to suggest that a lot of these funds are sticky and that users will come to the protocol and leave their funds in the protocol. Certainly some will leave, but there will be a substantial amount that will provide that liquidity that the protocol needs to function. And I think in my mind, that's the direction we're kind of headed when it comes to comp incentives. We're not going to entirely phase them out altogether because they certainly play a purpose in strategically improving new markets. But that is, I think at the same time, we do need to significantly cut back on the amount of tokens that are entering circulation, or at least the style in which they are entering circulation today.
Yeah, great point. Go ahead. Go ahead.
Sorry,
Dustin.
go ahead. No, what other levers do you think you would be pulling in order to kind of like, I guess, increase revenue and stuff? Like I'm kind of, I guess, thinking of like interest curves. Like, is there any sort of like management of interest curves or anything that you're looking at there to say like I know DAI's got a little bit of a different one, right? But it's still driving a lot of revenue. Like, do you look at something like that for USDC, or is that even applicable? What do you think?
Yeah, it's a great question. In the grand scheme of the protocol, and since literally back to V1, all of the innovation has been an underlying the invention of the C token, the invention of these interest rate curves, these dynamic interest rates. A lot of energy and time and effort has gone into the fundamentals of the protocol, and not necessarily the interest rate curves that are chosen, the reserve factors that drive revenue for the protocol. Some of the smaller details have fallen to the wayside behind the massive improvements in fundamental protocol that exists. So I think shedding some more time and effort on those, particularly those issues. At the end of the day, the protocol is a borrow lend market, and for a borrow lend market, we spend an awful small amount of time improving or researching interest rate curves. And setting those up is really important, I think, to driving the maximum amount of revenue and providing the best rates that we can possibly provide to the market, in addition to those reserve factors, which ultimately drive revenue to the protocol.
Yeah, no, I totally agree. That's kind of like the next wave of like, okay, we got something that's obviously got some market traction, right? It's like, how do we now like really optimize and fine tune, particularly from a revenue perspective? It was definitely like one thing that kind of came to my mind as I was putting some of this together. So Sami's kind of prompting here. Obviously, so another thing of revenue is liquidations, right? It's obviously become less of a factor here over Q3 and Q4. You want to kind of give us any insights you got there?
Yeah, so I think it was back in Q3, the protocol introduced an improved liquidation system that was actually brought about, I think, by the core team, and that was to decrease the liquidation incentive for liquidators and introduce part of that liquidation incentive for the protocol itself. So in the case of when a user unfortunately gets liquidated on the protocol, it's something about an 8% penalty that's put on them in their portfolio, whatever the borrowing. About 5% of that goes towards the liquidator's incentive. And essentially that just, gives them a 5% improvement on whatever the market rate was at that time to get them to come in and perform that liquidation. And I think it's about 2.8% or so that goes to the protocol. So that's been an interesting new line of revenue for the protocol. Personally, I'm not a huge fan of it. I think it introduces maybe a bit of an interesting incentive for the protocol that doesn't really need to exist. But at the same time, it's also something that users haven't really seemed to care too much about. So if you want to go the other direction, it's in theory something that you could crank up a fair amount more to drive revenues to the protocol. As we've seen at MakerDAO, liquidation revenues are a substantial amount of income for the protocol over there, especially over the back of what's occurred over the last month or so and the recent liquidations.
Yeah, no, it's definitely good insight to have. It's like, it's not something that's long term. You won't want to, be like FTX. I think has actually done in terms of big exchange, like they retooled their liquidation engine to kind of like attract more traders. And Compound kind of sort of long term, you don't want to be just liquidating your users because they're not your users after they get liquidated.
Exactly. You want to be the protocol is substantially more incentivized to keep the users around and keep them healthy and try to keep them informed of the risk that they're taking rather than profiting off of their demise.
Right. All right, cool. So that kind of wraps up, like, I guess, sort of the financially section we've got going on. I want to kind of peel into more of the governance and kind of like what's happening, in governance world, as well as kind of looking forward, what does the roadmap look like and things like that. Before we jump in all through there, like, I know you kind of gave a little brief overview of like what GFX does. Can you just kind of paint the picture, like who else is in the community? What roles are they playing? We mentioned Open Zeppelin.
Yeah. So the compound community is a fantastic one since it's one of the older ones in the community. So you have both the older crowd who has a ton of experience and seen a lot of the hardships that DeFi has gone through. The folks like Robert and crew, and some of the others in the community that go by anon names like BLCK and Tennis Bowling and others who have really been on Discord hanging out long before the comp token even existed. And a lot of those individuals that have seen the protocol go from having tens of millions of dollars to now having $6 billion in TVL, having liquidations being predominantly performed by individuals and trading firms, now being predominantly formed by algorithmic systems that are all entirely on chain. So the landscape has changed significantly, which is really cool to see. We've got awesome more recent additions to the team and more recent relative like Tile Ether in the protocol, and we have certainly other older ones like Arrow ARR00 in the protocol who do some great work. So there's a great collection of individuals who make up the protocol and are the ones who are like day in day out. I'm sure I'm forgetting a few that I should be mentioning. And then there's also now kind of the more recent additions of Gauntlet and Open Zeppelin to the mix, who provide a bit more of a strategic, steady hand on the protocol and are highly incentivized to participate in a meaningful fashion as well. So it's a nice economy that is constantly developing. Isn't always super functional, and there's certainly its shortfalls regularly. But ultimately, it's a nice caring community for the protocol, and it's improving that protocol over a long period of time.
Yep. So kind of touching on that, I know that there's this DAI direct deposit module that basically a partnership between MakerDAO and Compound. And then when you also think about the Coinbase DeFi yield product integration, so like how do you sort of incentivize people to go out and get partnerships like that? Because those are such important partnerships for the protocol. But it seems hard when you don't have like some type of centralized business development team that's working on forming these partnerships and connections. So how do you really push the community into just constantly looking for new opportunities just to grow the protocol?
No, it's the nicest way you can put it is that it's very challenging. There's not a lot of incentives, so a lot of the participation that does come about in Compound and lots of DeFi is just from people's genuine interest in the protocols and perhaps from the notoriety that comes with participating in these protocols. Similarly, there's very few things in the world that I think someone with a keyboard and some smart ideas can affect billions of dollars in capital, and that allures, I think, quite seductive to a lot of individuals. And that's like one of the reasons I certainly got involved in finance and trading, and then in protocol governance ultimately, is the fact that anyone can do anything really in this space as long as you just kind of write a good logical argument about it. You can get pretty far just repeatedly performing that strategy. I think in the long run, though, unfortunately, that doesn't really work out in forever. That's a nice way to get jump started and lean on the community in the early days. But in the long run, I think we're going to see DeFi not morph into what exists in the corporate world, but certainly lean on some of the progress that they've made. There's certainly a tried and tested model in corporate governance and in just general how companies function And I think we'll begin to see some more of that. GFX Labs has our own proposal up right now that we're in talks with the community about becoming more of a core contributor from the outside of the protocol, introducing some interesting ideas like KPIs and whatnot to incentivize our participation to make sure it's worth our time. And similarly, the protocol gets what they want from the relationship, and everyone can dedicate meaningful resources to improving these massive protocols. But ultimately, it's a lot of interesting, challenging conversations that are being had that are slowly driving the whole DAO space forward.
Yeah. Thanks for sharing your views on that. Now we're kind of running out of time, so maybe we can wrap up with talking about Gateway for a bit. So I know Gateway was announced in March 2021, and it was supposed to be this independent blockchain that would serve as like the infrastructure for cross-chain interest rate markets. So you'd have various start ports on different blockchains, and then they would all kind of report back to this shared liquidity. And there are talks about using like a cash stable coin. And I believe Compound Labs came out with, an update a few weeks ago. And as we all know in crypto, time moves like 10 times faster, right? And so a lot has developed in the cross-chain ecosystem. And I'm assuming the team has kind of, woken up possibly to the new challenges, especially the cross-chain problems that we've been witnessing lately. When you think about like the Thorchain hacks and the wormhole hacks that were going on. But can you give us a little bit of a summary on like the new approach that Compound Labs is planning for, the V3 of Compound?
Yeah, absolutely. So they took a lot of the feedback from participants over the period. While Gateway was a really credible idea, it was also a very big and hard to execute idea. To your point, we've seen with some of these protocols trying to do cross-chain things is a ton of work, extremely risky, and it spreads out the code base substantially. And so I think the team decided to take a more iterative approach to developing Gateway and saying, okay, well, what are the things that we need most right now? What are the good ideas from the protocol? Because there was a lot going on in Gateway that was fantastic apart from the cross-chain implementation. There was a lot of really great features regarding capital efficiency and assets in participation and leverage. One of the really great things I think particularly retail is going to enjoy in the new protocols, it's substantially simpler. It's a one-way market in the sense that there is a list of assets that are supported as collateral assets, and then there is a single defined asset that users can borrow. So unlike today, where you can borrow and supply anything, and it's very much a generalized money market, protocol decided, hey, seemingly Labs decided to make a bet, and I'm not going to say words for them. So this is my impression of the kind of decision making here was like, if the vast majority of the capital in DeFi and these money markets is interested in going leverage long, let's build a protocol that is optimal for leveraging long. So let's set it up in such a way where, hey, there's a single asset here that you are borrowing, and that is dollars, or it can be any stable coin. And then the governance can add assets on the collateral side and say, these are your supporting. Let's remove all the logic for borrowing any asset. Let's simplify it down to only supplying assets as collateral. They can't be rehypothecated. And it makes the code base substantially simpler, substantially more gas efficient, which I think retail is going to appreciate because to use Compound today is not inexpensive. And in the long run is going to make it also then, back to the Gateway point, substantially easier to deploy and process and run on other chains. So it's very much an iterative approach, and definitely certainly attacked from what Gateway was proposed as back in last March. But it's one that Labs feels confident they can deliver in, and that everyone is very excited to see and use.
Yeah, I found the idea of just one borrow asset pretty interesting because when you look at the current Compound protocol, most of the borrow demand is for just stable coins, right? And so if you just had one stable coin that was worth borrowing, it would just significantly reduce your code base and the complexity required for going cross-chain. So yeah, overall, I thought it was a very interesting idea and approach.
Yeah, should be good fun. I'm really looking forward to having it, and the new risk tools in it regarding capital efficiency is certainly improved as well. So I think it's who wouldn't want to use, essentially cross-margined MakerDAO? A big reason why I personally don't use MakerDAO is the fact that, well, I own multiple things, and to have separate margin accounts for every single asset that I have to maintain, it's a bit of a pain. I'd much rather use a system that allows me to pool that all underneath one roof. In my mind, mitigate some risk that way when it comes to liquidation. And that's exactly what they're delivering.
Yeah, DeFi is already complex enough. So really reducing that complexity and just keeping it as simple as possible for retail is just as important, I think, like you highlighted.
Yep. Yeah, I think, and the nice part too is, there will be a good opportunity here for V2, the current protocol that exists, to run in tandem for a long time as V3 exists. There's a lot of room for a generalized money market that exists, as we've seen. And there's also a lot of room for just a specifically margin long version of Compound. And so I think these things will operate well in tandem. I certainly think V3 will end up being the most popular one because people ultimately love being levered long, like myself. But it should be good fun.
Yeah, I'm excited. Dustin, any last questions you can think of before we lose Getty?
You know what? I think we should probably ask the chat or the community if they have any questions. Feel free to drop it in there. Stay on for like the next minute or two, get anything answered.
Well, it's been a lot of fun talking about Compound. I could honestly go on endlessly about this protocol and a lot of the other protocols that exist. I think it's a really interesting time to be in DeFi and in money market. While there is this kind of like quiet bear market occurring in DeFi, there's a lot of really bright people that are putting their heads down and developing some novel protocols that are going to continue to progress, like kind of the forefront of DeFi.
Yeah, I think the Compound community owes you and GFX Labs, a big thank you for all the effort that you guys are putting in. I got a chance to read through your proposal, your GFX Labs proposal as well, and I really like the kind of the topics that you guys are wanting to focus on for the new changes of Compound. I'm looking forward to kind of seeing GFX Labs play a bigger role as just a contributor in the Compound ecosystem.
Appreciate that. Thank you very much.
Yeah. Well, looks like no questions really. So we'll go ahead and just wrap up. Thank you so much again for being here. It was a pleasure speaking with you.
Yep. Appreciate it, Getty.
Cheers. Everyone have a nice rest of their Thursday.
All right. Bye, guys.
See ya.